Marc Franklin is Deputy Head of Multi-Asset Solutions Asia at Manulife Investments. He's with us. Marc, good morning. Great to have you with us here. Looking at the headlines, basically out of Russia, Ukraine, and the meeting tomorrow, should we dial back expectations for an announcement tomorrow, Marc? Eventually, something may happen, but out of the first meeting tomorrow, you think we should keep hopes a little lower?
Good morning. The reality is that it's a very complex situation. There are objectives on the Russian side which clearly don't overlap with the objectives on the Ukrainian side. It's not just about striking a deal, even if it's verbally communicated. It's also the nature of the deal and the extent to which all parties feel that it can hold. In general, though, if the musings coming out of the meeting are somewhat positive, it could be in the short term helpful for risk appetite across global markets. And it may actually serve as a bit of a disinflationary tailwind for those types of exposures which people have built into as a geopolitical hedge or an inflation hedge as well. And then the opposite applies if there's no seeming breakthrough from the conversations tomorrow.
The street is hoping for a breakthrough because then the hope lies that the secondary tariffs on India for procuring Russian crude oil can be lifted. So that additional 25% could go away. So we'll be watching that very closely. But generally, the geopolitical dynamics between US and India have been a bit unfavorable. And the FIs we've seen relentless selling pressure by the FIs. What's the view now on India?
It's a great question. So there was one school of thought saying that India is very much a domestically driven economy, not as sensitive to global trade dynamics as other markets, and therefore somewhat immune from the tariff regime that we're now moving into. But the other way to look at it, of course, is that the US is very keen for the Indian government to open up domestic market access to foreign players, to imports. And so equity market constituents have perhaps more to lose from that opening up. And that's probably been a bit of a headwind for Indian equity market sentiment in the recent days and weeks.
Hi, Marc. Good to see you. When we chatted last as well, you said you had your neutral stance on India. Now, we have underperformed for the last many months. Do you think you're gradually believing that it's time to get into India? And also, what are you reading in terms of the economic activity here in India? I recall we had chatted about the credit growth not picking up. And that continues to remain a bit of a sticky point. But the hope is that that picks up. So your reading of the Indian economy, and do you think the Indian markets are coming to those levels when you want to gradually shift that neutral stance?
The two factors are somewhat intertwined. You need some kind of macroeconomic catalyst, a re-acceleration to drive flows, both domestic and overseas, into the Indian equity market. We still officially remain neutral on India at Manulife. One of the things that is incredibly helpful for policymakers is both CPI and WPI inflation really moving in the right direction and creating room for policymakers to cut rates. But the RBI, to some extent, rightfully so, points out that a lot of the disinflationary forces are coming from the food sector, and the potential is for that to reverse at any point and without much warning. So they still remain somewhat cautious, but clearly the more they feel able to cut rates aggressively, the more it has a chance to reinvigorate credit demand and then rebuild a new credit cycle in India. But for the time being, loan growth does remain somewhat sluggish by historical standards, not in absolute terms, of course. And that also explains why the Indian banks have somewhat lagged the market in the last month or so.
Absolutely. Marc, we'll leave it there. Thank you very much for joining us. Good speaking with you here on CNBC TV18. It's a quick word coming in as far as markets are concerned. We'll take a